Markets Policy Partners was thrilled to host Chris Wood, the chief equity strategist at Jefferies, for a live interview. Chris, for decades, has been a top-ranked emerging markets strategist whose views span politics, policy, and economics and financial markets.
At the hedge fund, whenever Chris would come through town, he was always an integral part of our investment process. So I think you guys are really going to enjoy this one.
Welcome, Chris Wood. Thank you very much for joining us today. You are a road warrior for decades and decades. And I suppose the most important thing to talk about is there anything different about today's environment than what you've seen over the past?
Well, I suppose that the key thing is we've got some weird things in this cycle because of the post-pandemic dynamics. So things are definitely a bit different because a lot of fund managers are not in their office. They're still working from home. So you have a hybrid situation where maybe you do a meeting and half the people are in the office, half the people are at home. So that's one clear difference. And it's interesting to see how long that will last. And another interesting dynamic of this cycle right now is you have clear evidence in the US, particularly of restructuring in the white collar into the labor market, where you see big job losses being announced by big tech. But you see the opposite in the blue collar area of the labor market, where companies are almost hoarding labor because they had such trouble finding labor coming out of the pandemic. So I think that's one key area where the post-pandemic environment is creating some unusual distortions.
The Fed is talking about the need to get inflation down by forcing labor out of the market. If you have that dynamic, is that part of what is slowing things down on or keeping the economy hotter? And how does it unfold when you have what must be high income laborers losing jobs and lower income laborers in shortage?
I just think what it means is it'll just take longer for the blue collar end of the labor market to weaken. But I definitely think it'll weaken. I just think that's the explanation why it hasn't weakened so far, because all the evidence from the small company surveys, as we came out of the pandemic, it remained very difficult to source labor. Some people retired, maybe the people are getting jobs which don't show up in the data. You've also, in Democrat states, got more European-style welfare. So, as long as the case in Europe, there's reduced incentive to work. So, there's a variety of factors. But my base case is the recession kicks in. It just kicks in later.
Mm-hmm. The inflation is one of the topics that is foremost in the media. In your meetings with professional investors, is there a different focus than what we hear about reading newspapers?
No, yeah, well, the time to be focused on the risk of inflation was in the spring of 2020, when the Federal Reserve essentially engaged in what I called at the time MMT-like policy, where they printed the most extraordinary. We had this huge expansion in broad money supply growth in America. That was used indirectly to finance transfer payments. So Americans were basically paid money to do nothing. That artificially stimulated demand. That's the key source of the inflation surge we saw in the following 2 years. And the supply chain bottlenecks were an aggravator of that inflation, but they weren't the core cause. The core cause was the monetary explosion. And if you understood that money supply can create inflation, then that was the time to worry about inflation. So from mid-80s to early 2020, I always had a disinflationary, deflationary view of the world. I was partly influenced by being in Japan in the early 90s. And so that deflationary view basically was maintained all those years. But in spring 2020, when I saw that broad money supply surge, I basically changed my view, because unlike the monetary expansion after the global financial crisis, which basically we saw a big expansion in narrow money supply, we didn't see the expansion in broad money supply, because coming in the pandemic, money went into people's pockets. So that was the explosion in inflation. The Fed really woke up to that in November 21 when they did this dramatic U-turn. But I think the key thing short term now is what people in the markets are focusing on is that inflation can really collapse in the first half of this year, partly because of a very, very positive base effect. So we had 0.1% drop in inflation in December, month-to-month headline inflation. If we repeat that, this is just purely hypothetical, if we repeat that for the next 6 months, inflation, I believe from memory, will be 0.8% year on year, including in the June data published in July.
And I guess it'll matter what the economy is doing at that moment, because the Federal Reserve has stated they're going to remain tight. And if inflation data starts coming in negative, what will that do for the psychology of the market, and what will that do for Federal Reserve action?
Well, if the Federal Reserve will blink, the overwhelming view of people in the market is the Federal Reserve will blink, because they've seen the Federal Reserve do U-turns too many times before. And the noise level will be huge if the headline inflation really falls to that level, because headline inflation is now, headline CPI in America is now by far and away the most important monthly data point in the markets. So that's why the 2-year yields gone down a lot this year. That's why the people are focused on the inverted yield curve, and that's why the projections of the market on where interest rates are going differ from the Fed. I mean, my base case is we have a long-term higher inflation, but in the first half of this year, people need to understand the base effect is extremely positive for headline inflation to come off. It's just an arithmetic thing. Mm-hmm. But what unwinds what's in my base case is that Fed tightening monetary expectations peaked in the November FOMC meeting, when Fed Chairman Powell did what I call his wannabe Volcker Act, because he's trying to pose as a tough guy. Since then, monetary inflation expectations peaked, the dollar peaked, and that I stick with that view. But what throws that view out, what makes that view wrong, is if we have another spike in energy prices, be it driven by geopolitics or some other factor. Because if energy prices spike, headline inflation rises sharply, then inflation expectations rise, and then the Fed can't stop tightening. Because the Fed has to now focus on headline inflation, because the Fed lost credibility by failing to understand that the money printing was going to cause inflation. So the Fed has completely lost its credibility in the last 2 years, and is in the process of trying to regain it. And so from 1980 to 2020, the Fed was able to get away with talking just about core inflation, but now they have to focus on headlines. So I think energy is the wild card.
I guess that's a very important part of the global economy, and from time to time it becomes more important for investors. Let's talk about energy a little bit. What is the long-term outlook in your view of supply demand and what it's likely to do? What are the key drivers?
I still want to remain invested in energy. Energy was my favorite sector, especially in the US last year and the year before. It was the best performing sector 21, best performing sector in the US 22. So there's a risk of staying too long in the trade. I'm saying that my base case is a recession in the US later this year. So if there's a traditional cycle, you should be selling energy, but I'm not selling energy for a variety of reasons. One, I want to retain energy's exposure as a hedge against a geopolitically driven spike in inflation, which basically undermines my base case. Second, I think I have the dangerous view that this cycle is different, because in my view, the normal demand destruction you would get in a recession will be offset to a significant extent by the massive supply constraint in the energy sector, particularly oil, which is the consequence of the political attack on fossil fuels in the last several years, which has reached sort of extreme proportions in the last 2 years, which has basically disincentivized the oil and gas industry to invest, and has had the practical consequence of meaning that this OPEC and Saudi in particular is now the swing producer again. And the other problem for the energy sector is the US shale, which was the big area of growth in the last decade, has peaked out geologically. So even if energy prices rise sharply, you won't get the growth in shale some people would expect, because the best areas have already been fracked and the law of diminishing returns has set in. So I think oil is very sensitive to any geopolitical spike. China's coming back, so that will increase demand for energy, because the one area where we had demand destruction in oil in the last recent quarters was China. But it's not going to lead to a massive surge in oil short term, because the Chinese, I believe, have stockpiled a lot of oil. They've used the opportunity to buy cheap Russian oil to build their stockpiles. So they've done the exact opposite of the Biden administration, which has clearly used up a lot of the US's strategic reserve.
How important was the SPR for the energy prices in the last year? And will it have the opposite effect if the government starts rebuilding the stocks?
Well, I think you should only believe they're rebuilding the stocks when you see it happen, because they've already said they wouldn't, they wouldn't. So I'm not going to believe that until they start doing it. But my key point is energy supply constrained fundamentally because of the politics. And people are disincentivized to invest in energy because of the political attack on energy. At least I'm talking in the developed world. But the problem with this political attack on fossil fuels is neglected one simple point, that we still consume fossil fuels, and there's very little evidence of that changing anytime soon. So the best source on energy consumption is the BP Energy Book, which comes out globally. So in 2021, fossil fuels still accounted for 82% of world energy demand, which is a pretty big number. And my guess, when the 22 figure comes out, it will be higher than 82%, because a lot of people had to burn coal last year. So there's a huge difference between the political rhetoric on this subject, at least, and the practical reality.
You just brought up China. How important is China on the minds of everybody? You have great connections over your career in China. What is the reality about the COVID breakout right now, and what's likely to unfold on consumer behavior and government policy there?
Well, the key thing in China for everybody, global investors basically are not engaged in China, because many of them in the last 2-3 years have decided that China was uninvestable. And those people who are still invested finally sold in the big meeting of the Communist Party late last October, I believe, when President Xi was re-elected. I shouldn't say elected, reappointed. Yeah. And when you had the dramatic political theater surrounding former President Hu Jintao, which shocked many people, including myself. So then you saw capitulation selling in China-related stocks, and that was the bottom. 2 weeks later, the Chinese government announced the central government package, which I was expecting to help to shore up the residential property market, which had a big downturn caused by the COVID policy. The package came out better than I was anticipating, because I thought they were just going to make the SOE developers take over the projects, of these unfinished projects. But actually, they injected liquidity directly into certain favored private developers. The same month, you had growing evidence. I was in Hong Kong in mid-November. By then, people in Hong Kong knew that China had finally lost control of Omicron, and it was spreading wildly. They managed to maintain control up till October, which was extraordinary, but they finally lost control. And we realized then that they were easing the COVID policy, because everybody knew the cases were rising, but the restrictions were being relaxed. There was also a very important signal I mentioned at the time from October. The Chinese president was sometimes photographed in public not wearing a mask. So it was already clear that what I called at the time closet easing was underway. So at that point, you needed to buy the Chinese stocks, and you definitely needed to buy the big liquid domestic demand proxies for consumption, of which Alibaba is the most obvious. But then in Christmas week, the week of Christmas, we had the most important news in Asia last year, which happened at a time 95% of brokers were not in their offices to communicate it. And that was a complete U-turn on COVID. And basically the Chinese went to herd immunity. And then after then, obviously the stock market just exploded more. So the stock market's discounting a big pickup in consumption and travel, which in my view will definitely happen. And so global emerging market money has been in a rush to get back into China because China and the internet stocks in particular are a big part of the benchmark. Global emerging market money, global emerging market funds, global investors are not in China. Investors who are not dedicated to emerging markets are not involved.
It's one thing for the government to drop the COVID restrictions. It's another for individuals to operate as if COVID is not a threat. Are individuals operating as if COVID is not a threat, or are they scared and still hunkering down?
Well, no, there's growing evidence. There's growing evidence that COVID peaked by early January in the major cities. And the question is, when will they be at herd immunity? So while I'm sure there's a lot of individual concerns, I think China's going to follow the playbook we've seen in other countries that once you let it spread, it happens very quickly. and then you have this revenge consumption dynamic. So anecdotally, you can't get on a flight to Bangkok right now. It's all sold out.
And it's
from China.
And that demand has barely begun.
Barely begun. So the two obvious stocks to have bought the moment you realize this was going on was for the consumption Alibaba, and for the travel what used to be known as Ctrip. It's now I think trip.com. Yeah.
Yes. And so how long? So this has legs. The Chinese market should be an outperforming market for a while, you believe?
Yeah, this has legs. So the any pullback should be bought because the market got very cheap at the bottom. It got to about 8 times. It's probably around about 12 times. But the big mean reversion trade has happened, but I would add on any pullback. There's a perfectly legitimate argument that these arbitrary policy swings we've seen in China in the last 2 years, which are very, very different from what we had before, mean that Chinese stocks should trade at a bigger discount than historically. That's true, but that kind of thinking in the short term is academic. And so the key thing in China right now, let's say between February and May, the key thing is now, does demand for property come back? Because you had a big property downtime last year, which in my view was entirely driven by the COVID policy. And so the key issue is, does demand for property come back? Which my base case is it will, because a lot of easing policies were announced last year, which were ineffective because of the lockdowns, but those easing policies remain. So my base case is the Chinese jump on the trend normally, and they will see the opportunity for property to rise. But if the demand has not come back by May, that will tell us that, this extreme COVID policy last year has materially damaged middle-class confidence. So that's the key thing I'm going to be watching out for.
China, professional investors in the middle to late last year began speaking about the promise of emerging markets as an asset class after a decade of underperformance. China is the largest component of that. Is this a knock-on effect if China starts growing more rapidly and the market starts doing better? Is this something that drags along other countries?
Yeah, well, the irony is actually I was bullish on emerging markets at the end of 2021 because actually China was in a totally different easing cycle. So Jerome Powell did his U-turn on inflation and started signaling tightening in November 21. By then, China had just started to ease monetary policy, fiscal policy, and policy towards the property market, having basically been tightening during most of the pandemic. So it made sense to go into China and emerging markets late 2021. But then we had this extraordinary situation where the Chinese president, contrary to the advice of his technocrats, did not adjust the COVID policy for the reality that Omicron was too infectious to make these locking down any practical anymore. So that's the reason China economy collapsed. But otherwise, the rest of the emerging markets behaved remarkably well last year, given that we had two things going on which are traditionally very negative for emerging markets. One is a strong dollar, two is the most aggressive Fed tightening cycle since the late 70s. So ex-China emerging markets behaved remarkably well, which in my view just confirms they would have how well they would have outperformed if China had been open. So what we've got right now is China joining the party. But if I had to explain, highlight an area which outperformed global benchmarks last year, but historically is negatively impacted by strong dollar, higher US rates, I would highlight Indonesia that outperformed global markets. So yeah, I think we're on the brink of a sustained period of emerging market outperformance in equities. We've already had, by the way, which is often missed in this discussion, we've already had many years of outperformance in bond markets of emerging markets.
Interesting. We interviewed Amy Oldenburg, who runs emerging markets for Morgan Stanley by asset management, investment management. And she had pointed out that over this last decade of underperformance of emerging market equities, the allocations had also declined to near record lows of something like 3%. Is that your experience in your travels with investors who are involved in emerging markets? And would you expect that this is going to reverse?
By every law of logic, yeah, it should reverse. I'm sure the allocations to emerging markets have come down a lot, and to the more extreme end of emerging markets, what is called the frontier asset class, the allocations have almost collapsed. So in my view, there's huge potential for money to flow into this area, but there will be some people who won't be comfortable investing in China. So you also have growing interest in emerging markets ex-China asset class. So I think it makes sense to, if you're on the investment management company, it makes sense to offer both products.
One of the countries you know well over the years is India, which is, I believe, the second largest component of emerging markets. Let's talk about that. What are some of the characteristics of India, and is this a one of the more attractive areas of emerging markets?
No, yeah, India I know very well. India has been my favorite stock market to own for many years from a long-term standpoint. So I always say, and I still say, that if you have to own one market for 10 years in the world and you're not able to sell it, you should own the Indian market, because this is a strong domestic demand story. It's got positive population dynamics. There have been significant economic reforms, particularly under the current Indian Prime Minister Modi, and a lot of good companies. So India is undoubtedly the best stock market in the long term. Short term, though, India is expensive. It's trading at 19 times forward earnings at the start of this year, and India is being sold right this year to fund increased positions in China.
And then the rest of the emerging markets, Amy pointed out, tend to be relatively illiquid. And so if there happens to be a period of outperformance that sparks more interest, you might wind up with one of these situations where there's more money chasing a smaller supply of stocks that could drive valuations beyond what most people think is reasonable and keep going. What's the risk of that?
Well, that's a risk, but that's a risk. That's a risk after it's already outperformed. So to me, liquidity is a movable feast. So last year, Indonesia had daily trading volumes of sometimes of $1 billion a day. At the Asian crisis, Indonesia was trading, after the rupiah blew up in the late 90s, Indonesia was trading $20-30 million a day. So liquidity is a movable feast. So the key point is to get positioned before the liquidity arrives.
Yeah, that's right. We spoke with Russell Napier recently. We also spoke with Lynn Alden recently, and they spend a lot of time talking about long-term debt cycles. And how do you look at the current situation of the global financial industry, and how important is this to investors today in their travels?
Well, there's always this whole global debt thing's been around a long time, and clearly we had understanding there was too much private sector debt when we had the global financial crisis, and then we had a lot of government debt added on. So the huge government debt levels in most of the G7 world is a reason why at a certain level of bond yields, the fiscal deficit, the budget finances will become unsustainable. So that's a reason why you're likely to get down the road of more policies of formal financial repression. But that's another good thing about the emerging markets, because the emerging markets, by and large, have lower debt levels, lower government debt levels, and they've had since 2008 in the global financial crisis, the vast majority of these emerging markets have maintained what I will call orthodox monetary and fiscal policies, whereas the G7 world has been engaged in this very unorthodox monetary policy regime of zero rates, so in the case of Europe and Japan, negative rates, and all these episodes of quantitative easing. So that's why, if you're a bond investor, it's made sense to stick with the countries where there's still orthodox policy.
So where monetary policy is healthier in some of these emerging markets, does that imply that economic activity will flow to those countries better if the developed world with high debt problems winds up faltering?
Yeah, but I mean, the extraordinary thing actually is how much for years they've been the driver of the growth, but their stock markets weren't so good. So clearly a lot of US corporations were very good at driving EPS growth. And but there was also in the US a lot of use of debt and share buybacks and leverage to maintain high ROEs. That game's over now, but that's been going on since the global financial crisis. So there's just been a very US-centric world market. But the reality is a lot of the problems for emerging markets was simply that they were viewed as illiquid. So long as the US was doing well and it had the liquidity, why bother going to markets where you could get stuck because of a lack of liquidity?
What do you make of the US and European stock markets right now for the next period of time?
Well, on the US market, if you look at it on a price to sales basis, which is it's still as expensive as it was at the peak of the Nasdaq bubble in the early 2000s. So the US market, despite having corrected, is not fundamentally cheap. But the key issue for the US market today now is, are we going to have a recession? Because if there's no recession, the US equity market may have seen most of its correction. But if there's a recession, which is my base case, then I think there's significant earnings downgrade risk in America. So last year, the correction was all about multiple contraction because of the monetary tightening. So we had PE derating. This year, it's going to be all about whether we have a recession or not. Based on my view, based on the view of the economics team at my firm, I think the base case is the recession kicks in later this year. And the key reason is basically delayed is because of what we mentioned earlier, that it will take time for the blue collar, the labor market to weaken. But it's also the fact that we've had huge monetary tightening, and monetary policy works with a lag. So if you look at a chart of M2, I said earlier that it exploded in early 2020. That's history though now. The key point right now is M2 growth's collapsing. So that looks a bit ominous. That's ominous for the US economy, the US stock market. And then obviously we have the old, very long-established recession signal of an inverted yield curve. So actually, it would be extraordinary if there isn't a recession in the US on a 12-month view.
And how does that impact Europe?
Well, the funny thing is, in a funny kind of way, Europe looks in the short term less at risk of a recession than the US. They've obviously got this potential wild card in Ukraine. But right now, I'm overweight Europe relative to the US, and that's because I think there's one big silver lining for Europe, which is not the case in America, and that is there's a silver lining from the fact that the ECB got inflation as wrong as the Fed, because that has finally forced the ECB to end this always insane policy of negative rates, negative interest rates, and that is a big positive for European banks, because European banks have been liberated from this negative rate policy, and you can see that in the way the European bank stocks are traded. So they rallied hard when it became clear negative rates were ending. They sold off for understandable reasons when Ukraine broke out, because clearly the huge surge in energy prices dramatically increased recession concerns, but they've now rallied back to the levels they were at just before Ukraine. So no one ever explained, in my view, in a credible way, why they had these negative rates. No one's ever admitted at the ECB that it was a crazy idea, but I think everybody understands it was a crazy idea. If a policy is bad for your banks, how can it be good for the economy?
How about the Middle East and Latin America for emerging markets? What the Middle East, I understand, is attracting a lot more financial activity given Brexit and Hong Kong. Is that unfolding?
No, yeah, that's absolutely right. So I was in Saudi, UAE last quarter. So basically, the profile of the Middle East markets, what is called MENA markets, has increased dramatically for various variety of reasons. One simple reason that Russia was cancelled. Many emerging market funds had their energy exposure in Russia, because Russia had some very good oil companies that were very cheap. That market's been effectively cancelled. So now the Middle East is the best place to get your energy exposure. But there's also something else going on very dramatic in the Middle East, because the most important market by far, and economy by far, is Saudi Arabia. And Saudi Arabia, everybody who knows the Middle East tells me that Saudi Arabia has changed beyond all recognition in the last 5 or so years. And it's benefiting the economy from a key supply side reform, which is that basically that half the population has entered the economy. I'm referring to the female population of Saudi Arabia. And this is just a huge domestic demand booster. It's why the government is very popular. And there's also something very interesting going on in the capital markets in Saudi Arabia, because the government is encouraging the corporate groups to list on the stock market, and they're listing at 20 to 30% discounts to prevailing valuations, which is clearly positive for this mostly retail investor-dominated stock market. This will develop the capital markets, and it will also broaden out the stock market, which historically has been very dominated by energy and banks. So this policy is fully underway in Saudi. It's also happening in UAE. And last year, the MENA markets were better from an investment banking standpoint. This is the one area where you saw a lot of deals. So yeah, and so the profile of the Middle East markets and the global emerging market benchmark has increased dramatically, and that shall continue. Another issue for emerging markets, similar to what I discussed with energy, is how will the commodities do in a world where we're worrying about US recession? So historically, copper is very cyclically sensitive, but with this whole copper being used to drive all this explosion in EV vehicles, etc. There's a structural driver of growth for copper, and there also seems to be, like in energy, significant supply constraints.
Over the years, you've written a lot about gold, and I'm curious what you think about it now, and by extension, whether digital assets in the world of digital assets represents any competition to gold.
Yeah, Bob. So on gold, if you have the view that the Fed's going to stop tightening, gold is clearly got some attractive features. My first point about gold is that gold behaved remarkably well last year, and basically performed its traditional function of preserving purchasing power, because gold corrected marginally in US dollar terms, and certainly significantly outperformed equities and US Treasuries, which both of them declined by the most in more than 50 years. And that's impressive performance by gold, because we had a real strong dollar and we had a far more hawkish Fed than anybody thought possible, in late 21. So basically, I think gold will be positively geared to an end of Fed tightening. It's performing well so far this year, but we have not yet seen ETF flows into gold ETFs come back. So that's what you need to see to believe it's going to get real momentum. Last year, we had ETF outflows out of gold early last year when it became clear how hawkish the Fed was going to be. So I think what supported the gold price last year is, and the World Gold Council basically published interesting data which showed the biggest increase in buying by central banks for many years. And my guess is that that's central banks outside of the G7 world who basically wanted to buy more gold as a hedge, because many countries were shocked by the US action regarding freezing a significant part of Russia's foreign exchange reserves. So that extreme weaponization of the US dollar has clearly had the effect, the understandable effect of causing many central banks to buy gold. But the World Gold Council published data. There's a lot of speculation about Chinese bought a lot of that gold. They're not, the Chinese data is not clear. But the bottom line is that it's the largest buying of gold according to World Gold Council for more than 50 years. And it happened at a time when, there were ETF outflows. And I checked the data last week. So far, despite this rally in gold this year, we have not seen the money come back into ETFs. Gold mining stocks corrected last year, but they outperformed the US benchmark. Gold mining stocks are basically very cheap, and they're being run much more cost effectively or more efficiently than they were then in the last cycle. So I would own some gold mining stocks too, yeah.
And how about those who think that digital assets represent potential economic growth or an alternative to gold? What work have you done in the digital asset space, if any, and what do you think?
Well, no, I've been following the crypto thing since about 2017. I was a bit late to focus on it. I should have focused on it earlier. Part of the problem was everything about crypto was in its own alternative space. It wasn't really in the conventional media, so you had to really follow the podcasts. But I believe this whole thing has some legs. I think Bitcoin has basically been tested through very serious bear markets. So to me, it's kind of stood the test of time. So actually, I put an allocation into Bitcoin in my global sovereign bond portfolio. When did I do that? I did it at about, when Bitcoin was at 20,000 on the way up, because there was evidence institutions were beginning to buy it. It became possible for institutions to buy Bitcoin. So to me, that justified a bit of an allocation. Also, there's a demographic issue. Right, as of today, it doesn't seem to be the case that millennials have any interest in buying gold. This is basically a market which is dominated by boomers. So there's a practical problem with that, because for gold to do well in future years, you need some millennials who want to buy it. So right now it seems the millennials who think like the gold bugs among the boomers want to buy Bitcoin, not gold. So I think there's a practical reality to have some Bitcoin. Because I personally think Bitcoin has stood the test of time. I mean, it's pretty impressive that Bitcoin has not corrected more, given what's been disclosed. Some of the things have been exploding in recent weeks, months. And we have another halving of Bitcoin next year. But so long as the Fed is tightening, all this crypto asset class is going to remain under pressure. But there's probably, as we speak, there's probably a 30% chance, 35% chance Bitcoin's bottomed.
How about central bank digital currencies and stable coins? What role do you think they may play in the future?
Well, I think the key, what the key thing that hasn't gone wrong yet, which could potentially go wrong in crypto and cause another stress test, would be there's some major problem of some of the remaining major stable coins. So that's something I think to watch out for, but so far that hasn't happened. Otherwise, this digital currency stuff, to me, the most interesting area there is China, because they're really pushed. That's basically operating now in China. And so what I want to do is check how that is perceived when I go to China, which I hope to do in the not too distant future. But I haven't been in China since late 2019. So that's the problem. We can't have, that's one thing I want to check out on the ground.
Doesn't seem like there would be much in the way of China not pressing that CBDC as their main internal currency.
I know they are, but I'm just what I'd be like
Eventually,
yeah. What I'd be curious about is how the people view it. But clearly, this is reached. Clearly, the if you're a government and you have a digital currency, then you can program that currency. So let's say if you had a big recession, rather than cutting rates, what you could say, you could issue people money and say this money is only going to be valid for like 3 months, because you want to get people spending. So that's the sort of thing you can do.
Yes, it is a perfect Chinese weapon.
Yeah.
Tool.
And tool. The Chinese run a command economy. The Chinese don't pretend to run a free market system. They run a command economy, and a command economy only works if the economic actors in the economy, the companies, individuals, respond to the policy signals. So China's command economy always works very well. So the Chinese property market traditionally was like a set of traffic lights in a developed world, where people paid the traffic light signals. When the Chinese signaled they were tightening property, they stopped buying. When the Chinese signaled they're easing, the green light came on, they started buying. So what was so traumatic last year and must have disturbed the policymakers, will have definitely disturbed the technocrats, is that the Chinese basically started to ease in late 21. They turned the green light on, the property market started to go up, but then this whole crazy COVID policy kicked in, and for the first time I've been watching China, those easing signals did not work. So M2 growth went up last year in China, but mortgage lending just went straight down. So that's why it's very important to watch the property market in coming months to see if the traditional dynamic comes back in.
What do you expect governments around the world to be doing about their debt if interest rates remain stubbornly high?
Well, then there's a risk of first of all, a lot of domestic institutions will be put under regulatory pressure to own government bonds. You're talking the long end, higher bond yields. Yeah. Because at a certain level, these fiscal, bond yields go north of 4% in the US and something to 5%, then, that sort of level, the fiscal dynamics start to become unsustainable, most particularly if foreigners stop buying the bonds. And clearly the Chinese have been selling US Treasury bonds. The Japanese could repatriate their capital if their bond yields rise, which are rising. So at a certain level, it becomes unsustainable. And then I think the politics kicks in and you get policies to kind of force people to own government bonds. And you even have the extreme potential of yields being fixed up the yield curve as they have been in Japan in the last several years. But that's an extreme option, but it's certainly a quite possible policy. But to me, that's more likely in the developed world than in the emerging market world.
And let's talk about Japan, because they seem to be out ahead on this particular problem, and things seem to be reaching a climax. How important is this in your meetings with investors, and how important is it in your mind? I
know this whole extreme Japanese monetary policy has definitely coming to a head. I've been calling it basically should be compared to a pressure cooker. So Mr. Kuroda, the BOJ governor, I've always called him Kamikaze Kuroda, because I've always thought his extreme monetary policy had the potential ultimately to blow things up. So last year, him maintaining his peg on the 10-year JGB yield had the practical effect of causing the yen to collapse. So that basically impoverished the Japanese people through imported inflation at a time when your average Japanese salaryman was lucky to get a wage rise of 2%. Most got less. So Japan's a very passive conformist society. So people have taken that, but even in Japan, the pressures have been building. Mr. Kuroda due to retire from BOJ governorship in April. I was in Japan last September. Everybody was of the opinion that the policy would be adjusted by whoever else takes over the BOJ, because his policies as personally associated with Kuroda as the COVID policy last year was associated with the Chinese president. But he's kind of reduced the worst risk of a blow up by adjusting the yield curve control in December from when they fixed the 10-year Japanese government bond at 50 basis points, not 25. So that has partly reduced the pressure, but there's still huge. The BOJ is still having to buy huge amounts of JGBs to hold the line. The BOJ owns more and more of the government bonds outstanding. It owned, the last official data in the third quarter, it owned more than 50% of the JGBs outstanding, but its ownership would have increased substantially since. So it's a matter of time before this policy is further adjusted. And the question is, does the market force it, or can he hold the line until he succeeded in April? In the meantime, to me, it's just a matter of time. It could happen any time that the Bank of Japan will move out of negative rates, just like the European banks have done. But the real global potential consequence of this is if bond yields become de-anchored in Japan, then you have the potential for significant capital repatriation as Japanese institutions move their money back into a yen world, because they can now get reasonable income in Japan in yen terms. So what they've been doing historically is buying a lot of overseas bonds, and they've been hedging the currency. But last year they stopped buying US Treasuries, the Japanese, because the cost of hedging the yen basically removed all the higher yield pickup. So we could get significant capital repatriation. But the good thing about this all is that everybody's now focused on this. Whereas if it had just suddenly, it had been triggered by a huge market move, as it nearly happened last year, I think the consequences would have been more explosive. People can now see this risk, so I think they're more prepared for it.
Let's talk about geopolitics just for a moment. Ukraine and Taiwan. Last evening at 2 a.m., there was a news report in Bloomberg from a U.S. Air Force general who made the prediction that, or sent out a memo asking his troops to get prepared for something going on in Taiwan before 2025. And I'm curious what you think about the prospects for China making a move on Taiwan, and whether Ukraine is a lesson that would make them think twice.
Yeah, I don't think the Chinese are thinking about that actually. Yeah. So to me, my view is similar to the view of most people in Asia, that all the escalation on Taiwan both in the latter days of the Trump administration and under the Biden administration have come from the US side and the West in general. And all the Chinese do is react. They react to escalations. So under when Mr. Pompeo was Secretary of State, you had US cabinet officers sent to Taipei. That was a historic no-no. You had the Taiwan president called president. You had Navy vessels go into Taiwan waters. You had the Nancy Pelosi visit. So all the Chinese do is react to the escalation. The Chinese president has said he will sort the Taiwan issue out before he leaves power. But the key point, he's not planning on leaving power anytime soon.
Maybe
So,
not for a
yeah.
lifetime.
So I'm not being worried. I'm not being concerned about that. But there's a risk actually that the more the more this is escalated, the risk is that at a certain point, the Chinese government will start to look weak to its own population. It doesn't do anything. That's the risk, because everybody in China, rightly or wrongly, believes that Taiwan's part of China, even people who don't like the Chinese president, because that's what they're brought up to believe. But I've been more worried. What's been worrying me about Taiwan the last year is, from a stock market standpoint, is the semiconductor downturn. The other point, though, which hasn't got the attention it deserves, is that the US has basically announced a very aggressive policy towards China on semiconductors. US Department of Commerce last quarter, where they basically want to stop the supply of advanced semiconductors to China, which is a very dramatic development if it's really enforced, and if other countries go along with it, because what that will mean is that will severely cripple China and its ability to upgrade its economy through obvious areas like AI or autonomous driving. And given China's demographics, that would raise the risk of China being condemned to the middle income trap. So this is something which the Chinese will be desperate to try and get around. And the key question, which we don't know the answer to yet, is how tightly this will be enforced. But from a Chinese perspective, that's the equivalent of declaring economic war against China. This to me is a much more important thing than the political issue of Taiwan. But it has implication for the Taiwan semiconductor companies, like it does for the US tech companies, because they're going to lose revenue if this is enforced tightly.
And let's go back to Ukraine. How is this likely to unfold? What are the impacts for investors in your mind?
Well, I think the market's forgotten. At first point, I think the market's just forgotten about Ukraine. So Ukraine has the potential to be very positive, very negative. If we got a deal, that will clearly be viewed very positively. If we get a real escalation in Ukraine, then people start worrying again about outlying risks. So to me, but the market right now is assuming, what I'm kind of assuming for now, is extended stalemate. But if we start to see Ukraine making advances, because obviously the more they get tanks, etc., the more, then the market will start to worry about Russian retaliation again.
But for the time being, investors don't need to be too worried about what's actually developing, more about what might develop.
Yeah. Well, the practical reality is the market's not paying attention to Ukraine, because the market's assuming extended stalemate. If we suddenly saw Ukraine successfully cross into Russian territory or something, then I think the market will start to get worried about escalation.
Chris, thank you very much for a really great hour of great information. I really appreciate your coming on.
Okay, thank you, Bob. Good fun.